Inflation is up, but rates might be going down. Jobs data just got a massive revision. What does it mean for you? Oracle is making waves with the $300 billion AI moonshot. OpenAI is shaking things up with new governance changes. Klarna's BNPL reality check is here. Are you ready? Regulated long-term crypto futures are finally arriving. Plus, Phil Muscatello's quick guide to private credit risks. Stay tuned. The last minute could save you money.
Hi, Deep Thinkers. I'm Gary Broad from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. Last night, I traveled from Marrakesh to Fez, Morocco, and I'm excited to be talking with Phil Muscatello in Queensland, Australia. Phil is the founder and host of Stocks for Shares and Beginners, a fantastic podcast that helps amateur investors understand investing at a much higher level. Phil, how are you today?
I'm very well, thank you. Thank you very much. It's a pleasure and a privilege being on here. And as the host of the podcast, I stand on the shoulders of giants like yourself.
Well, I don't know about giants, but I am always impressed. You get great guests for your show, and I feel honored that you've had me on a few times. I'm excited to have you be the guest host for the Five Things.
Oh, thank you. No, thanks very much for that. And I guess what it's really coming down to is I'm just finding, because what I try and do is approach things from an amateur perspective, like you said, but I guess more and more I'm just trying to warn other investors about mistakes, traps, and what to watch out for, especially in terms of Wall Street jargon, which is deliberately designed to bamboozle us, which we've discussed many times
We
between us on the
have
podcast.
In,
Yeah.
in fact, my favorite, and look, I think it's important to give people the vernacular. It's important to give
Hmm.
people the language, right?
It
So
is
whenever,
totally. Yep.
yeah, whenever I write or I'm doing a podcast or speaking, I always use those complicated finance terms so people can hear them. But then I think it's really important, I'll always say that's just a fancy finance way of saying, and then give it to people in plain language. And people will often say, wait, that's all that is? Yep, that's all. But now you know the words.
That's right. Listen to the words, they'll become clear sooner or later. Let's jump straight into it. So we're talking about, okay, we've got seven things this time, not five things, seven things. And I'm honored to be presenting one of those things, thing
Yeah.
seven. So number one, the CPI rose and was above expectations. The Fed is still going to cut. So the recent uptick in the CPI, which was driven mainly by shelter, housing, there's another one of those terms. The Federal Reserve's decision-making process for interest rates cuts this month. How's that been affected?
Well, so for clarity, the Fed hasn't cut yet. I expect they're going to later this week. But last week we got the CPI, that stands for the Consumer Price Index. Whenever people talk about inflation, that's typically what they're referring to. When people say, inflation is up 2.5%, they're referring to the CPI. In this case, we got an overall increase of 2.9%. That was up from 2.7% last month. And the monthly change, which normally I don't pay a lot of attention to, but it was actually pretty hot number. The monthly change was up 0.4%. Doesn't sound like much, but it annualizes to just under 5%. That's two and a half times the 2% target, which itself is 2% too high. The core CPI, that number excludes food and energy. That was up 3.1%, consistent with last month. So, people are still saying, well, the Fed should cut. And by the way, they're going to. They're going to do that later this week. But I'm just going to point out they're doing it with these inflation metrics right around 3%, which from the Fed's point of view is 50% over the target. From my point of view is 3% too high. The other thing that I would add is you were correct in pointing out that the primary reason for the increase was shelter, right? Again, just a fancy word for housing. That's how the Bureau of Labor Statistics refers to it. And in this case, the housing statistics are lagged, and that just means we're now getting reports from months and months ago. It just takes a long time when a real estate deal is done for that to move its way through the system. And if any of you have ever bought property, it's not like you come to an agreement and you sign the papers and the mortgage the next day. It usually takes a few months to get everything complete. So we've got this lagging number, and I think we're going to see a decrease in the coming months in OER, that stands for owner's equivalent rent, which is the completely ridiculous made up way the Bureau of Labor Statistics looks at shelter. In other words, the CPI is high now, but I think it's going to come down in the coming months. There is zero evidence that tariffs have been a problem, and that's something that, fiat economists were hysterical over. President Trump was going to ruin the economy. Nobody was going to have money for anything, except tariffs have not led to big problems, and we're not seeing big increases in the durable goods category.
I know it's really strange, isn't it? Because it has almost been one of those tenets of classical economics that things like tariffs get in the way of free trade. Do you think free trade has been affected in any ways by the tariffs?
So here's the thing, Phil. I love that you're using that term free trade, because it's again, it's an academic finance term. When PhD level economists get together, they talk about free trade because, hey, that's a good thing. And they talk about, Porter's theory and comparative advantage. Okay, great. And these are things that were great in a classroom. They were great in academia. They were great in theory. But in reality, this is not what happens. Every country has some level of protection. And one thing that really entertained me when I was in Lisbon a couple of months ago, all of the European central bankers and the economists, they met in Sintra, Portugal, just like, I don't know, 15, 20 miles away. And Chairman Jerome Powell of the Federal Reserve got a standing ovation for saying, the tariffs were going to cause inflation. They like that, except Phil, I've had things sent to me here from the United States. Guess what? 33% tariffs on the stuff I've had shipped to me here. So they're against the tariffs on their products. They want access to the US market, but somehow it's not a disaster for them to tariff US goods going there. On top of that, everybody plays games with protection. As an example, Airbus, the French company, the European aircraft maker, they're subsidized by the state. That's just another way of giving them a comparative advantage of paying for it. Now, our European friends watching this might say, hey, wait a minute, your entire defense sector is funded by the state. Your government overpays them for things. Yes, they do. Everybody is cheating on this. So this free trade mirage, it exists in a vacuum. It doesn't exist in reality. On top of all that, the United States has had an issue. We have spent the last 40 plus years outsourcing everything, and we've sold off all of our industries. We no longer have the ability, pardon me, excuse me, we no longer have the ability to make things like semiconductors. Yeah, Intel makes, but at the very highest level, we don't make our own pharmaceuticals. We don't make our own protective gear. We can't make our own ships. This is a problem. And eventually, we really do need to start reshoring manufacturing for security reasons, for jobs. It's the other thing too is it's really easy to say, well, you've got tariffs, so the price of things will go up. Again, in a vacuum, in a classroom. But that's not what happens in real life. In real life, you end up with substitution and you end up with an increase in domestic manufacturing capacity. We talked about this a couple of weeks ago, where the automakers were saying, oh no, the steel tariffs are going to kill us. Except guess what? We have falling steel prices. Domestic manufacturing has increased. And so everybody does the static analysis, but the world is dynamic. If you change one thing, everything else changes. And so the analysis they're doing just isn't relevant.
So President Trump has been applying a lot of pressure to Fed Chairman Jerome Powell. Why does he want lower interest rates, and what is the pushback that's coming from the Fed?
So the reason the president wants lower interest rates is because the economy will run hot. Don't worry, I'll explain it. So if you have lower interest rates, what it does is allows people to borrow at lower rates, theoretically, not always. That didn't happen a year ago, but let's move past that now. And then if financing costs are lower, people are incentivized to build factories, to build plants, to invest in projects, to do a lot of real estate projects. We'll talk about that later, Phil. I know you've got comments on that, right? But that's, lower rates incentivizes building but it also blows up asset bubbles and makes things very, very expensive, right? If everybody's trying to do this stuff, you will have asset bubbles, and that works its way through the stock market as well. And President Trump is somebody who likes to judge his command of the economy and his success through the stock market. Well, lower interest rates means you're discounting future earnings of companies at a slower rate, which leads to higher equity valuations. So you blow up these bubbles. Well, why would Chairman Powell of the Federal Reserve be against that? Because they're trying to control inflation. And when you blow up asset bubbles and asset prices increase, you get inflation. That's exactly what the Fed doesn't want to do. Now, people have been saying, and I'm about to release a long macro piece where we talk about this. People have been saying, oh no, the president is politicizing the Fed. Guess what? The Fed has always been a political institution. For the first 20 years, 20 plus years after it was created, the Secretary of the Treasury was also the chairman of the Federal Reserve. The Fed back in the 1930s accommodated President Roosevelt's desire for an expansion of the welfare state. President Lyndon Johnson, a few decades later, literally picked up Arthur Burns and slammed him into a wall, strong-arming him into lowering rates. President Nixon pressured Burns to keep rates low to help his reelection. I mean, we've just seen this again and again and again. And I think it's hilarious that people are saying, oh no, President Trump is politicizing the Federal Reserve. Well, what did they think the Federal Reserve was doing a year ago in September when they lowered the Fed funds rate with inflation running hot just ahead of the November elections? It's no secret that everyone in that building despises the president. The Fed has always been a political institution. The only difference now is when Lyndon Johnson picked up Arthur Burns and slammed him into a wall, he did it in private. President Trump's castigating Chairman Powell in public. The only difference is we now have front row seats to watch the show and X or Twitter to discuss it.
So, what's your crystal ball saying, Gary? Are we heading into inflation or another asset bubble or both? Stagflation. There's some
all
people are
of the
saying.
above. Yeah.
Yeah.
So here's my crystal ball. We'll see. We'll know more. I think later this week the Fed reduces the Fed funds rate by 25 basis points. Again, just a fancy finance way of saying 1/4% or 0.25%. I think we get a short-term decrease in the CPI as the OER, the owner's equivalent rent for shelter, comes down and starts to reflect market dynamics. And then I think we're going to have long-term increases in inflation. And the reason for that is congressional overspending. It has nothing to do with President Trump, nothing to do with Chairman Powell. It's really just the fact that Congress overspends, and whether you're on Team Red or Team Blue, everybody spends too much.
Okay, well, let's move on then to the massive jobs revision that reveals Labor softer than expected labour market.
All
So
right.
anyway, so there was a 911,000 jobs revision for the year ending March 2025. And this says something about the accuracy of the BLS data. What do you think that's showing?
So the Bureau of Labor Statistics, their data has been horrendous. Phil, a number of years ago, I was following, these weekly or monthly jobs reports, and the market would trade off of it. And what we started to notice was you would get, like, let's say you would the market was looking for 120,000 jobs and you get 140,000 jobs, and people say, okay, wow, that's fantastic. They beat by 20,000 jobs. Everything's great. And then a month later, when no one was looking, there'd be a revision down by 40,000 jobs. But no one was paying attention at the time. And eventually I realized that the amount of the beat was almost always exceeded by the amount of the revision, and the revisions were almost always in the opposite direction. So, what I realize is the BLS, that's the Bureau of Labor Statistics, their data is horrible. Their accuracy is horrible. And here's what we got. A few years ago, we had a revision of over 700,000 jobs. And then a year later, we had a revision of over 700,000 jobs. Sorry, I think they were both over 800,000 jobs. Then earlier this year, we got a revision of 250,000 jobs. That was the one that caused President Trump to fire the head of the agency, McIntyre. And then we just got a revision of 911,000 jobs. This is millions and millions of jobs that have been wiped off the books after they were reported. Now, people are saying, well, it's not really their fault. More companies are not reporting, they're not getting them the data. Okay, fine. I believe you, but it's the job of the agency to get that data. And the thing that people were missing is the BLS was doing nothing to improve that data. We just kept getting larger and larger and larger revisions, always down. And so, the question is, okay, maybe it wasn't McIntyre's fault that they had bad data, but she wasn't doing anything to fix it. And these are three revisions of 750,000 jobs or more in just 2 years, covering 3 years. I mean, this is insane. President Trump was right to fire her, not because it was her fault that they got bad data, but because nobody was doing anything to fix it. She was in that position for years. So the BLS, they need to do something to address the situation.
And do you think they're going to be able to improve that? Do you think the leadership changes have led to any improvements?
Well, so it's too early to tell, right?
Mm.
The
These
leadership.
bureaucracies, they're hard, they're difficult to change, aren't they? It's like punching jelly sometimes.
They are, and in fairness, it is difficult. The United States is an enormous country, both geographically and by population. It has a very varied economy. It's not like everybody works for the government and you can just go to payroll and say, how many checks did you cut this week? We also have the real engine of growth in the U.S. economy is small business formation. Those, by definition, don't report a lot of data to the BLS. Okay, I got it. It's hard, but they need to do something. This isn't the kind of thing that they're going to be able to fix in a few weeks. The new leadership has only been there for a very short time, so they're going to need time to make whatever changes they need to make.
It's interesting because these kind of figures are seen by prognosticators to indicate whether a recession is brewing or not. It's really difficult to make those kind of judgment calls if the data is not giving you the full picture.
Yeah, that is 100% true. I think there
Because
are
we're all
some.
waiting for a recession. We're all waiting. These tariffs, they're going to bring a recession on any day.
Yeah, by the way, Phil, another place that the jobs data is inaccurate. Well, sorry, pardon me, not inaccurate, but people keep talking about a weak jobs market, but a lot of the jobs that have been taken out have been government jobs, right? In the 15 minutes before Elon Musk left Doge and before Congress basically said Doge couldn't do anything, they cut tens of thousands of government jobs. So, that's not really a loss of production. And that's actually influenced the data as well. So, we've got that and we know how many of those jobs have gone. We know how many people have signed up for unemployment insurance or, are collecting benefits. We have a pretty good sense of how many jobs are in the economy, like how many jobs are posted and how many people are looking for jobs. One thing that's also really interesting, and we're going to talk about this in the big macro piece that we're releasing later this week, is that while the jobs growth has been weak, that's also been offset by repatriations, right? So we had a lot of people in the country who were working illegally, and as they've gone back to their home countries, there's been this offsetting effect. So we've had fewer jobs available, but fewer people looking for those jobs, and it's kept the labor market in balance. And in fact, wage growth has actually been really healthy. So if you have a job, chances are you're staying in that job, you're getting paid more. Again, these people are facing less competition from people who are being repatriated to their home countries. So, the whole thing is really complicated right now. But the point of all this is people said that tariffs would be a disaster. They haven't been. They said that repatriations would be a disaster. They haven't been. Right. And, is the labor market as strong as it was a few years ago? It's really hard to tell. Like it doesn't look great right now, but a year ago, we were getting reports that were overstated by 911,000 jobs. So, what do you do with that data? In my case, not pay a whole lot of attention to it and just say it's not such a horrible thing for President Trump to replace the head of an agency that keeps having these almost million job revisions.
And that's the good news that's buried in the data, isn't it? Is the shift from people being on public assistance to becoming active labour market participants. Is repatriation the only reason driving this kind of change?
No, I think the key thing is wages. That that people are seeing opportunities, that there's been wage growth, and they're saying, you know what, I'm gonna go back to work. And that I think is a win all the way around. It's great for society when we're paying less in benefits to people and people are being productive and working. That's great. It's also good for those people in general. Being on public assistance doesn't lead to good outcomes. People are happier when they're working and productive and, feel like they're accomplishing something. So I think it's a win all the way around.
Okay, so moving on to number three, Oracle sees record surge driven by earnings and cloud deals. And this is about Oracle share price surging 40% last Wednesday, making the revolving chair of world's richest person around to Larry Ellison. I think Elon was there, Jeff was there. It's been many people who've taken this role. And yeah, what do you think that's meaning for himself? And, it must have felt good for that day.
Yeah, it wouldn't be bad to be the richest person in the world for a day.
Mm, mm,
To me, the interesting thing about it isn't so much that Larry Ellison had the top spot for the day. It's that his net worth went up by $117 billion in that day. So, Phil, forget making $117 billion over a lifetime or amassing that
mm.
much wealth. Try to imagine making more than $100 billion in one day. That's a
Yeah,
pretty good
because
day.
he's got something like what 40 something percent of the company still after all of these years.
Yeah, I mean,
Mm.
good for him. As somebody who went to the University of Michigan, there's a story out there that Ellison's partner, I think his girlfriend who became his wife, or is on his way to that anyway. She's a Michigan grad and leaned on him to fund the NIL deal, the name, image, and likeness deal for Bryce Underwood, who's now Michigan's starting quarterback. So thank you, Larry.
Fantastic. And actually, just interestingly, I just found out that Lake Michigan is big enough that you can actually go body surfing on it. I met someone from Michigan body surfing on some waves up here in Queensland. And I said, how did you become such a good body surfer? Lake Michigan's really big.
Well, the Great Lakes are enormous. I think people are
Mm,
used to thinking about lakes that, you stand on one shore, you can see the other shore. The Great
yeah.
Lakes are huge. Michigan has
Mm.
a surplus of water, which, should be a great thing for the state one day. But, it was nice. It was nice growing up there, being able to water ski in the lakes or go swimming. It's not necessarily like Australia's beaches, but you also don't get bit by sharks in a lake. So there's that.
Oh, oh, we love the Sharks here.
Yeah.
So, given Oracle's stock now trading at 45 times forward earnings, what risks can you see for this valuation?
So let's go back and talk about the reason Oracle stock jumped so much. They had strong financial results. They had a bunch of multi-billion dollar deals, but the big headline was a commitment from OpenAI to buy $300 billion from Oracle over the next 5 years. Boy, that's a huge number. So the risk is that any change in the AI field could cause problems for Oracle stock. But in addition to that, OpenAI, like that, and we'll talk about this later, but they're having a bit of struggle themselves figuring out how to make the company profitable. Right now, nobody really has a profit model in the AI space. And everyone's like, oh, good, the internet is free and, my AI chatbot is free and I can use ChatGPT for free. And, maybe we'll see because these companies are spending literally hundreds of billions of dollars on equipment, on,
Data
these
centers
accelerators.
and yeah. Mm.
Yeah, it's hundreds of billions of dollars. So the issue is they don't have a model, and it would be really easy to say, okay, right, but that's not really Oracle's problem. Like, if OpenAI has financial problems, who cares? Oracle will collect the money, and that's why people say, you want to own the picks and shovels company, not the miners, not the explorers. Um, but the thing is, like, let's go back to the internet boom and bust of a quarter century ago. And, Cisco stock did great until it did. And when your customers are having financial problems, you'll have financial problems. And do I know that OpenAI isn't going to be able to find their way through it? No, of course not. I don't know that they have any kind of problems, but right now their business model is raising money. And so I think that's the risk. You're paying 45 times forward earnings, assuming a lot of growth. The market's pricing in that growth, but what if somebody says, "Hey, wait a minute, we're spending hundreds of billions of dollars on these large language models and on the AI accelerators and all this stuff," and then realize, we have no way to make money off of this, and we need a profit model, and that may change things, and it may change how much people are spending.
And it also seems to me that it might be the case that the generation of power that's required to run all of these data centers could be, a barrier as well. I mean, who knows what's going to happen to power prices and how many power stations are going to have to be built. And I know you love your uranium story, and I believe that's why that's your gateway drug into AI investment.
Very much so, yeah. So, we are going to need more energy production. And in the United States, that it's going to have to be nuclear, right? Building more natural gas and coal plants just is not politically feasible. It doesn't matter if you agree, you disagree, it's just not politically feasible. It's not going to happen. You can't use wind and solar for always on kinds of things like a data center. It's also not economically viable. Nuclear is going to be the answer. That's going to come from SMRs, that stands for small modular reactors, just to give you a sense of these requirements. This OpenAI contract with Oracle, that one contract requires 4.5 gigawatts of power, right? I sound like, Doc Brown from the Back to the Future movies, right? 1.21 gigawatts of power. But that's the generation capacity of two Hoover dams. That is enormous.
That's
So,
enormous. Yes.
right, and where are we going to get that? And for people saying, well, they'll just use the grid. Okay, well, how long do you want to go without air conditioning and lights?
Hmm.
Because that's what's happening. And we own Talon Energy, thanks to Enrique Abeda at HX Research. He was the one who presented the idea. We did a webinar with him. That stock is up more than 3x what I paid for it personally, what DKI subscribers paid for it. But the reason that stock has gone up so much is it's in a part of the country, right, in Pennsylvania, where these AI data centers have created so much demand that power prices are spiking. And it's really easy to say, well, so who cares? Talon's making money, but they're making money from Amazon. If Jeff is a little less rich, why do we care? Well, the reason you care is because when there's that much demand for power and you can't just flip a switch and produce infinitely more power, Phil, I'm going to ask you this economics question. What's the one thing that can adjust?
The cost of the energy.
The price, right. And people
Yep.
are starting to see it, in their electric bills in that part of the country, using your air
Mm.
conditioning was very, very expensive. So, I can't fix that. I can't change that. But what I can do is own the power source that's going to power all of this stuff. And so, I think that's uranium, that's Talent Energy. Even right now, I'm looking at an SMR company. I don't know if I'm going to invest or not, but this is where I'm spending a lot of time and effort.
Mm. Okay, so keeping with the AI theme and OpenAI, and this is number four thing. OpenAI's bid to shift its hybrid structure faces regulatory issues. I've just been trying to understand this. Can you give me a bit more of a clarity about what's going on here? Because it started out as a not-for-profit OpenAI, didn't it?
Yeah, yeah. And so, this not-for-profit, the way nonprofits operate is they take in money, right? People say, oh, I'll invest, I'll give you money, there'll be donations. Okay. And the idea was to ensure artificial general intelligence that would benefit all of humanity. This sounds pretty good, right, Phil? Well,
Mm-hmm. That sounds great.
yeah, that was back in 2015 when, doing this meant buying, like NVIDIA GPUs that you could buy for, a couple $100, a few $100. And, now people are building out. Well, OpenAI just agreed to spend $300 billion with Oracle alone, right? There's a reason NVIDIA's stock has gone through the roof. There's a reason their revenue keeps, going up 50% every quarter. It's because the hardware has gotten really, really expensive. And so what happened was OpenAI realized, oh, wow, we've got a problem here. So they created a for-profit subsidiary that's OpenAI LP. It has a capped profit model. The idea was that they're going to attract investments, pay for computing power, compete in the fast-moving AI landscape. But hey, don't worry, we won't take too much profit. Well, guess what? That's a problem when you're competing with, Google and Facebook and Amazon and other companies and Elon Musk and other companies that like to earn a profit. And so what they have now proposed is that they convert the for-profit arm, which was supposed to be under a capped profit model, into what's a PBC, that stands for Public Benefit Corporation. It's a company, but it's a company that has a profit motive and mission obligations. Some of the educational companies fall under, like the online companies, they fall under, they call it a B Corp instead of a C Corp. Um, they're still trying to make money. And I think what's happening here, and I have no insight in OpenAI. I don't have anybody inside the company that I talk to. But I think what's happening here is they're realizing that they need tens or hundreds of billions of dollars of investor funding. And they either get that from people who want to provide this for all of humanity, which, there's just a limit. This is not, hey, we're going to a $10,000 a plate dinner. Um, and so they're realizing, we're going to need a business model. We need a way to make money from this. Otherwise, we're not stable. And that, by the way, is the risk we were talking about in the prior segment. With Oracle, you're paying 45 times earnings, hoping that their customers don't go out of business.
Mm. Who are some of these people that are investing so much money in AI? And what do you have any insights into what they're possibly thinking and how they can make money out of this structure?
Well, they've it's incredible. Their Series F round was like $40 billion. The prior round was $10 billion. The round before that was, $8 billion. They've raised, almost $70 billion. That's real money for
And
this.
this is a company that's a not for profit.
Yeah.
We should underline that point.
Yeah. So I think the answer here is people are investing because they expect to earn a return. They're not putting in tens of billions of dollars, because they want to produce a public utility.
Mm.
Um, the real question is, how do they come up with the business model? And I think one of the things we're going to see is AI is going to be a differentiator. Like, you want AI to teach your kids, right now it's free, but it may not be in the future. And we've just started a new company, Deep Knowledge AI, basically to provide customized AI solutions for people. And these are not cheap, right? This isn't the kind of thing that, we can do for everybody up and down the street. And so, people, look, I get it. It's really hard to do. It takes a lot of time and effort. People want to get paid for it. At some level, OpenAI is their subscription model is going to have to change from the current $20 a month.
Mm. So again, this is coming back to the point you made earlier that there doesn't seem to be yet a business model for AI in any company that's developing it, and there's a lot, hundreds and hundreds of billions of dollars being poured into it every year.
Yeah, and if you look at it, like for Apple, AI has been a detriment, right? Apple spent
Mm.
money on AI, and the only thing it's gotten them because they haven't had good solutions is, they've lost some market share and they've lost a little bit of interest. And so, people are saying, wait a minute, why would I buy the new iPhone for $1,500 when you don't have great AI? And so, Google is using this stuff to maintain market share. So a lot of spending in order to hold on to what you have. Microsoft tried their, I think it was a $30 a month Copilot subscription for business users. The issue is those things aren't so well integrated with like the apps on your computer. It's really hard to get your AI to make a phone call for you or to, handle email for you. It's not impossible. Microsoft's probably going to be the company to do it, but people weren't that interested. I personally, I do pay $20 a month for Chat GPT. And right now I find the experience to be pretty frustrating. It seems to be very good at, not doing what I want it to do. My friends who are, I think, better AI users than I am are having more success with it, but whatever. I'm paying $20 a month to sort of play around with it and see what works, what doesn't work, what I might be able to get it to do. But they're going to need, literally to make their business model work, millions and millions, hundreds of millions of users, like Netflix kind um, of subscriber growth. And they're it's going to take a while before they see it. And the question is, are people going to do that when Gemini is free and Grok is you can get that with a subscription to X for like $8 a month. So there's a lot of
I
competition in
personally, I
space.
personally love Grok in unhinged mode.
Oh, what have you asked it?
Unhinged mode. I just turn it into a kind of an argument based on how hopeless I think AI is.
Oh.
This is it. This is in the app. This is in the app, by the way. You can get it into voice mode, and it's great fun to play with. It's also got an argument mode and so forth.
On
Doctor
more
mode.
than on more than one occasion, I've threatened to EMP my version of ChatGPT.
What's EMP?
Electromagnetic pulse. It would
Oh.
just, fry everything.
Okay, well, moving on from the AI space, and we're going now buy now, pay later, going public. Klarna's, their code is KLAR IPO, opened on Wednesday, the 10th, raising $1.4 billion. Now, we're talking about Klarna here, which is a Swedish company, which has actually had a lot of history here in Australia because our largest bank is integrated with Klarna, and you can get Klarna via their banking app as well. And they've done very well out of this IPO. So let's have a look at it. And how does Klarna's market value exceeding 17 billion at close reflect investor sentiment towards the buy now, pay later sector?
Well, so first of all, worth pointing out, that's a pretty heavy valuation for a company that's like this whole buy now, pay later thing didn't exist just a few years ago. So they've built this up out of nothing. And what we saw was that when the deal was announced, sorry, priced, the guys who priced it actually got it right. The stock shot straight up, and 2 days later, it had come down to very close to the IPO price. So, basically, it went up, it came back down, but settled right around where they priced the deal. So good job by the investment bankers there. My bigger concern is that the buy now, pay later payment plan, with Klarna leading the competition, it just leads to poor credit decisions. It's something we've talked about a lot on the five things. And Phil, I know you focus a lot on educating people. There is this sense that, oh, well, it's free. Trust me, it's not free. These companies make their money one way or another, and they're going to make their money off of you. I've also seen data that says some huge percentage of young people, and it's primarily young people using buy now, pay later. They buy something using it, and then a month later, they're shocked when they get a bill. And to me, this is inconceivable. Like, what you thought because you didn't hand the person cash at the store that it's free, but apparently that's what they think, and then they're shocked when they get a bill. Well, guess what? This is all going to lead to poor credit decisions. You don't pay your bill, somebody's going to take money out of your pocket. And we're just seeing this increase in credit usage combined with an increase in non-performing loans, right? I mean, it just leads to bad decisions all the way around.
I think the perception is among many young people that it's better than getting a credit card because you're not paying those high interest rates. And that somehow that they're on their side because they're doing such strict credit reporting or credit research on you as a user that they know if you're going to get into trouble. And, basically, if you do get into trouble, your credit is cut off immediately. And the idea that a company like Klarna is actually on your side as a consumer much more than a bank. But all this, it's all perception stuff, really, isn't it? There's nothing really, really solid about the whole business model of buy now, pay later.
Yeah, Phil, the idea of assuming that the person who wants to loan you money is concerned for your financial outcomes and that they will know what is best for you. This is the equivalent of saying,
We
well,
laugh at
I
this. We
know.
laugh at this.
Right. Yeah. This is the equivalent of saying, I no longer go to my doctor. My crack dealer takes care of my health concerns because he doesn't want me to die. He wants me to keep buying from him. Like that is completely insane. The idea that I don't need to make any financial decisions. The people who lend me money will know what's best for me and will know how much I can handle. No, you need to be responsible for your own decisions. If you make bad decisions, you're going to have bad outcomes. And look, I get it from the point of view of a lot of these young people. They've been lied to their whole lives. They were told, go into debt to get a university degree. Don't worry, it doesn't matter what it's in. You can get a useless degree and you'll be fine. But they're finding out the job market doesn't value certain degrees, and having 5 and 6 figures of debt is a problem. They were told, just work hard, you'll be fine. But the truth is, it's going to be very hard for them to buy homes. They've been priced out of the market. Um, and the reason for that is because the United States overspends. And so, the same system that's telling them, hey, you need to be careful and look out for your finances. It's our government that's spending insane amounts of money and creating the inflation that's making these people's lives miserable. And we shouldn't just pick on them, Phil. And these may be bad decisions, but it's worth pointing out that an increasing amount of buy now, pay later business is for groceries, right? It's it's easy to make fun of the person who says, I'm going to upgrade my iPhone 16 to the iPhone 17, and here's $1,500 for it. And, for a phone that's very, very similar. But when people are using it for groceries, you have a bit of a systemic problem. And so it's really easy for these people to say, wait a minute, nobody around me is making good financial decisions. The government isn't. I'm suffering from inflation caused by their overspending. How am I the problem here? I get that. And there's no part of this that's fair, that's equitable, that, they've just been lied to their whole lives, and it's all horrible. But I still say, do not count on Klarna or your credit card company to tell you how much money you can spend. You need to be responsible for your own decisions, whether it's fair or not.
So, despite from that, as an investor, what are your thoughts on Klarna? Is it fairly priced, and does it have a future?
Well, it definitely has a future. Fairly priced, I don't know. I didn't look at it, and I'm not looking at investing in it. And that's for two reasons. The primary reason is their non-performing loans, I think, are increasing. It's a problem when people are, listen, it's one thing to say it's scary when people are using buy now, pay later to buy groceries. But, they're also using it at Chipotle. Like, they're financing a burrito. Okay, this is a problem. You can't repossess it. So I
I
think
know it's
Klarna is
incredible
going to,
that the number of places you can buy now, pay later. It seems extraordinary, for something that's worth $5, $10.
yeah,
Yeah.
exactly. And so, look, I think they're going to be looking at higher losses. These are things that can't be repossessed. It's not part of their business model. They've got it. Like, they write something off, they're writing off 100% of it. I think they have a customer who doesn't really understand, what they're doing. They don't understand what they're buying or what they're financing. I just see this as a problem. In addition to that, one of the things we've talked about an increasing amount on this show is that stable coins are going to be a huge attack on the banking system. I think it's going to affect companies like Bank of America, or Citi. I don't know what it's going to do to buy now, pay later. I don't know that they may be competing with each other. That part isn't clear to me yet. This is the kind of thing that I want to watch, and I'll put my capital in right now.
For some reason, I've always loved the name CBOE. Chicago Board Options Exchange. It just seems to be one of those places that harks back to a different era of open call outcry trading. Obviously that doesn't happen anymore, but now CBOE is bringing crypto into normal everyday usage, and this is about futures contracts to be offered by CBOE. Tell us about what's going on there.
Yeah, so they're going to launch these long-term futures contracts. They're called continuous futures. It'll be for Bitcoin and Ethereum. The contracts are going to last up to 10 years, and they're designed to mimic popular perpetual futures. So, like a derivative contract with exposure to an asset without an expiration date. These are currently offered by offshore crypto exchanges. But those offshore exchanges aren't so well regulated. I think that's why the regulators went for it. They basically said, okay, people are investing in this stuff. We can either let them invest offshore in these unregulated or poorly regulated markets, or let them invest through the CBOE with more better regulated products. And the way they're going to do it, the product will price daily through cash adjustments to provide continuous market exposure. Again, regulated market. It'll also allow hedging of positions, and I think that's a big deal. Personally, I've owned Bitcoin since it was 15,000. I've never sold any. When it's dipped, I've just bought more. I have a long-term thesis there and don't really care that much about the volatility. It's annoying, but doesn't affect the long-term thesis. But for institutional investors, that kind of volatility can be a problem. They don't like showing those, monthly numbers or daily numbers, gyrating all over the place. So they can use hedges to smooth out some of that. And, for them, it's a marketing thing.
Okay, I guess I'm not sure if I'm saying it correctly, but if someone's making a market for these options, do they have to actually own the underlying asset behind it as well?
So yes and no. From a regulatory point of view, depending on the product, they may not need to own the Bitcoin or Ethereum underneath it. But if they don't, they're taking on an enormous amount of risk. So
that's going naked, isn't it?
yes, in some ways, it's not necessarily the right question, only because they tend to do it anyway. So, in fact, let me ask you a question, Phil. In Australia, do you have to wear your seatbelt when you're driving? Is that a law?
It is. Yep.
Okay. I'm gonna make this up. For the next 10 minutes, I'm the head of Australia. I'm the emperor of Australia, right? And I have just gotten rid of the law. It is no longer a law that you have to wear your seatbelt. Your seatbelt is no longer regulated by the state. So you have to drive somewhere later this evening. Are you going to wear your seatbelt?
Of course, always.
Right, exactly. So whether the institutions that are offering the other side, the sellers of these options, these perpetual options, whether they have to or not depends on the details of the option, but you better believe, that they don't want to take unlimited risk. They're generally trying to capture a spread. And, it's why, and we won't go into the details of this because it would take a really long time and get very complicated. But when you hear these gamma runs or, gamma hedging or, like the gamma short squeeze.
Yeah, getting deep into the Greeks.
Yeah, exactly. Basically, what it means is that a lot of times you have these institutions that are short, say, Bitcoin. Bitcoin starts to rise. They're taking losses. They have to buy it back. Otherwise, their losses get too big. So basically, they don't want unlimited exposure, on either side. So for them, it's like a seatbelt. They're going to be hedging themselves, even though the hedging can lead to market activity that amplifies moves. And unfortunately, that goes in both directions.
So why is this a milestone for US markets?
If we go back just a year and a half ago, you couldn't even have a Bitcoin ETF, right? It was April of 24 that we finally got Bitcoin ETFs. Before that, the only thing you had was the Grayscale Bitcoin Trust, which frequently traded at a gigantic premium to net asset value and then a gigantic discount. Again, something we've covered in prior versions of the five things. So now, you not only have these ETFs allowing people to own things like Bitcoin in a regular brokerage account and just buy the ticker rather than have to figure out how to self-custody, which is not as hard as people think it is. But you have these derivative products. And I think what US regulators are realizing is either provide people a way to safely own the product that they want to buy, or they're going to go to other markets. They're going to go to other places. And this really is, I think, an example of the market exerting pressure on the regulators, saying, regulate this or we're going to buy it someplace else.
Is this part of the changes in the dynamics brought about by the change in administration since last year? Because I think it's much more of a crypto-friendly administration now than it was in the past, and that there would have been a lot more regulation on the table if it had been a win for the Democratic Party.
I think that's mostly true. Although, in fairness, when you talk about a win for regulation, these markets are not unregulated. These are the regulators saying, okay, you want to buy this, here are the regulations, here are the rules. They're actually saying, we're going to provide you a regulatory framework if you're a pension fund and you want to own Bitcoin, if you're a bank and you want to sell options on this stuff. And so I don't know that any of this is a loss for the regulators, but there's no question that the Trump administration has been much more crypto and Bitcoin friendly than any prior administration, although, it's not like we can go back that far, right? The Carter administration didn't have to deal with, crypto, neither did President Reagan or, anybody until very recently. But, I think it was also very smart of the Bitcoin and crypto community they were huge donors to the Trump campaign. And, fortunately, one thing that I think was maybe undercovered a little bit, people realized that Barron Trump was a huge contributor to his father's election win because he understood the podcast space. And I think he went to his dad and said, you want to get on these podcasts and go talk. And, one thing President Trump is phenomenal at, I read about him going like on Joe Rogan, walked in, no notes, no prep, no like literally just walked into the studio. They put a microphone on him and he spoke to Joe Rogan for 3 hours. Like the guy, he knows his stuff. He knows the things he wants to talk about. And people will say, oh, he doesn't know everything. Okay. But the stuff he wants to talk about, he does know. But he has, his other sons, Eric and Don Jr., like those guys, they were big in the crypto space, and I think they understand it. And so, he had people very close to him who were advising him to go in that direction. He got a lot of money from the crypto space and the Bitcoin space. And so, we have a more friendly environment. And I think it's a good thing. I think, better to offer the American people who want to own Bitcoin but aren't comfortable with self-custody than just offer them the ETF. Let these pension funds benefit from the rise in Bitcoin instead of, watching other products do better, right? This helps people's retirement. And you could say, well, what if it goes down? Listen, I'm a long-term holder on this, right? Like I own this. It's my largest position. So I have my money up on it. For people who want to have these derivative products, the options are let the CBOE do this and provide a regulatory framework, or people are going to go offshore and do this in less regulated environments. So, I actually view all of this as a positive, and I think it's okay for the financial world to go to the regulators and say, we want these products. Provide us with a regulatory framework that will provide us with the guidelines where we can do this legally. Right? Instead of going behind your backs. This is not a bad thing.
Okay. Shall we move on to private credit?
Yeah. So, Phil, one of the things I really admire about you, besides all the great guests you get on your podcast, is you have made it your mission to help amateur investors and new investors and people who are just befuddled and overwhelmed by the complexity of finance. You've made it your work and your mission to help explain all of these complicated things to people. You have this great podcast, the Stocks and Shares for Beginners podcast. It's on YouTube here, so we'll put the link in the description. People should go subscribe to that. And I think one area where you're particularly strong is understanding Wall Street jargon and the kinds of things that people who want to sell you financial products will tell you to make you think that something is a good and safe and appropriate investment. And it might be and it might not be, but people have to have the tools and the language to understand it. So one place we're starting to see an increase in attempted sales to retail, to amateur investors, is in private credit. And I know you've got some thoughts on that. What's going on? Why are people trying to sell private credit? Let's start with what is private credit. Let's just explain what that is to start.
Okay, well, again, I'm not used to being interviewed by like this. I'm just doing some research and finding out. Just to step back just for a moment, I became interested in it because I was reading in the financial press that regulators here in Australia, and I've also found out since that regulators in the United States are concerned about this space for a number of reasons, which we will go into. So I started researching it and seeing what it was all about. And it seems to be, it's something that can be applied to any business, but let's just talk about the real estate, commercial property side of things, which is where private credit plays a big role. Now, in the past, banks, in many cases, would provide credit to, say, a developer who wanted to put up an office tower. But now there is a market that is at arm's length to the banks that provides funding, say, for an office block. And this was an example recently, and I've used it as an illustration in the written part that comes along with this podcast episode, is that there was an office development here in Australia, in Sydney. Sorry, I'm in Queensland now. I've lived most of my life in Sydney, but now I'm out in the boondocks. And this, I mean, you would look at it, knowing Sydney as well as I would say, yes, this would be a fantastic investment. There's a new rail line going in below it. It's right in the heart of the business district. It's going to have gun barrel views straight up gorgeous Sydney Harbour. But then for a whole number of reasons, this company or the development has still not started. I think now nearly 3 years after it was first funded and proposed. And the reasons behind it were things to do with interest rates remaining high, the work from home situation, so that there's not as much demand for office space anymore, and construction costs going up at a great rate as well. So this is now, for me, from what I've seen, is that it's revealing some of the problems with the sector, and especially that of valuation. And how do you actually value something like this? Now, private credit, of course, I'm still trying to work out the interchangeability of terms like private credit, private equity, corporate bonds. But they seem to be just different facets of the same thing, where someone is investing money into a private. That means it's unlisted. You can't work out a value based on a daily basis. Like a private company that, a publicly listed company would be. You can see what the value of it is moment by moment, whereas it's very opaque in terms of what some of the investments in the private credit space are. I don't know. Am I explaining it well? Just you can sense my nervousness here in trying to explain complex financial instruments. But anyway, sorry, just before you put your oar in here, I'm just trying to say this because I've noticed as well that there are investors who see private credit and they see high returns. They're seeing higher returns than if they put the cash in a term deposit or in the bank or some sort of savings deposit. And again, these are the kind of dangers I'm really trying to point out for people who might be muddling into this area, and some financial advisors saying, "Oh, you should have your money in private credit. Look at all these things that are going on at the moment." Anyway, over to you, Gary. Have I
All
made
right.
any sense in that in that sort of diatribe?
I think you have, and it's okay to feel befuddled on this. The topic is really confusing. So why don't we actually go through if people want to invest in bonds, and that's really what they're doing. Let's
Because it
talk
is a
with
kind of bond, isn't it? Really, it's a corporate
yeah,
bond by another
it's
name.
right. It's a loan. It's a loan.
Yeah.
So let's talk about the kinds of loans that you can make and what kinds of returns you can get and just help people understand where the risk is, right? So the most basic kind of loan is depositing money in your bank, right? And people say, well, wait, I have a savings account, I have a checking account. I'm not loaning money to the bank. Yes, you are. Yes, you are. You are giving them your money and they're holding it and they pay you a return. They pay you interest. Now, it may be very low, but you're getting that. Now, and I don't know what it's like in Australia, but in the United States, we have Federal Deposit Insurance Corporation, FDIC. And
Hmm.
what that means
Exactly the
theoretically,
same. Yeah.
right? Yeah. And I'm going to
Two hundred and
really
fifty
lean,
thousand dollars, I think. Yeah.
yeah, per account. And
Hmm.
I'm going to lean really hard on that word theoretically. Theoretically,
Hmm.
you have no risk. Yeah, I know. But if the bank goes under, this insurance will pay will pay you. Now, we have not had a situation before where people haven't got that money, but we've had bank failures. You can have a bank failure that is greater than the amount of insurance in there. So, but that would be the easiest safe thing to do. Okay. So let's go one more step up. You could buy treasury bonds or treasury bills in the United States. Now, is that good? Well, you're going to lose purchasing power slowly, right? So inflation tends to be higher than the rate that you're getting on these bonds. If somebody could say, "Oh no, no, the 10 years at 4%, it's at 5%, inflation's 2.9." You said that earlier this episode, yeah, but inflation's not 2.9, and so over time you're going to lose purchasing power in this, but you have the advantage of you're going to make nominal returns, just a fancy way of saying that you're going to get more dollars back than you put in. Um, and the government, if they run into trouble and they do have financial trouble, they'll just print more dollars. So you will get paid, right? The purchasing power of what you get paid with may be low, but you're going to get paid. Okay. Now
Mm.
let's go one more step up in risk, and that would be corporate bonds, right? And let's talk about investment grade. You go to like AT&T. You'd be like, well, AT&T, it's a really good company. It's really safe. They have lots of bonds outstanding. Okay, great. And if you loan AT&T money, you receive a slightly higher return than you would on treasuries. And the reason is there is a possibility that AT&T could go bankrupt. They can't just print more dollars. And, you get paid a little bit more. Then above that, there are, junk bonds or high yield bonds where you're loaning money to companies that, you think they're going to pay you back, but it could go either way. And so you get a little bit of a premium for taking the risk that things could go bad. Now, what happens with private credit? The advantage of everything that I've said all along is you can always get something. You can go to the bank and say, "Give me my money back." You can sell your treasury bond. You can sell your AT&T bonds. You can go sell your high yield bonds. You might take a loss, but you can sell that right today, right now,
Mm.
and go do that. Okay. Um, what happens with private credit is you meet with your financial advisor, and they say, "Well, Mr. Muscatello, you've done really well. We now see you as a candidate for our private investments, right? Congratulations, we're graduating you. You're moving. Oh boy, I must be important. I have money. I'm talking to a private investment guy. Phil, why do you think you're getting the private investment guy? Is he doing it because he loves you? No, he's getting
No.
paid. These
Hmm.
guys make a gigantic fees. The fee schedule on these private investments is enormous, right? There's a reason why that you're talking to the private investment guy in the special room and they offer you, your cappuccino instead of just, the coffee that's been sitting out for 5 hours, right? And they make you feel like you're really important and you're doing really well. And maybe you are important, or maybe you are doing well, but you need to understand they're doing this because the fee schedule is different. They make more money off of it. Okay. And then they say, well, we've got this deal. And by the way, you're going to get better returns. And you think, oh, good. Yeah, this is the thing I heard about. I have more money, so I make more money and I get higher returns. And yes, there is some truth to that, right? And generally, better deals are offered to wealthier people. The poster child for this is Warren Buffett himself. Whenever any company has stress or a problem, they go to Uncle Warren and they say, hey, would you like to invest with us? We're going to give you a huge discount, right? We're going to make this huge, right? Phil, you and I don't get that opportunity. Uncle Warren gets that opportunity, right? And so you think, okay, great, I'm going to get a better return. Well, here's what you give up. You give up, one, the fact that you're investing typically in like these individual projects, and it's not like you have a whole company. It's, as you said, you're investing in a building, a real estate deal, which may or may not have the cost structure they tell you, which may or may not start construction on time, which may or may not start construction at all. But the key thing is you're giving up liquidity, right? If you need that cash, you can go sell your AT&T bonds. You can go sell your government bonds. But if you need that cash, you're not going to be able to sell your private credit. And, you could go back to your special banker and say, hey, can you sell this thing? Oh, boy, I don't know. I have to look. I have to see if I can find a buyer. And, to go find a buyer, I'm going to need a fee for that. And whoever's going to buy it, they're going to want to pay a discount. And we'll let you know in a day or two. Right. And so maybe you get your money, maybe you don't, but you're really locked into these private kinds of things. And so that's why they're offering you a better return. It's, could it work out? Sure. And private credit isn't necessarily bad. And the person offering you a private credit opportunity isn't necessarily evil. I'm just pointing out, be aware of, because Phil, you love this kind of education stuff, be aware of the terminology they're using. Be aware that the person selling it to you he is incentivized to sell you that instead of something else. Be aware that these deals do offer a higher return, but they're riskier. And be aware of what it means to invest in something where you're not liquid. And if you have a problem, if like there's a leak in your roof and you need money to fix it, right? You go to your private banker and say, hey, I need money right now. Can you get me out of this investment? Well, that may or may not happen. And if it happens, it's going to happen at a discount. So I'm not saying these are bad people. I'm not saying these are bad investments. I'm not saying you can't make a really good return on it. I'm saying understand the risks that you're taking, understand the landscape, understand the person on the other side of the table from you. He's not necessarily your opponent, but he's not your friend either. So just understand all of this and protect yourself. And this is really, really important. Right? When these investments are sold, they will imply that if you don't do it, you're missing the opportunity. And there is that FOMO, that fear of missing out. Okay. I really, really want to emphasize this, right? It's don't be taken in by promises of high returns. And remember, it is okay to pass on an investment, even if it makes money later on. And you say, oh, if I don't do this and it makes a lot of money, I'll feel foolish. Okay, so what? Right? It's okay. I pass on plenty of investments that later turned out they would have made a lot of money. They weren't right for me. I didn't think the risk reward was good. Right? Just like it's like going to Vegas, right? You can bet it all on black. Your return profile is negative. You do that enough times, you're going to lose all your money. But hey, the person next to you doubled their net worth. That doesn't mean it's a good idea. It's okay to pass on something, even if it works out later. Don't feel badly about that. Now, if you do, as an investor, if you do think, well, this is something I want to do, but I'm worried, I'm nervous, okay, it's okay to do it. Allocate a small amount of capital, right? Pick funds with good managers.
Always a small amount of capital. Yeah.
Yeah. Don't put your net worth, don't bet your mortgage, your ability to pay your mortgage on something like this. That's all.
Yeah. And it's also to do with the valuations. I mean, that's the other part where the systemic risk can happen. I mean, if you suddenly have a downturn in the economy and all of this private credit is all going into office blocks all over the world and the valuations come down, and that will filter through the system. A lot of these are also, there's a lot of debt involved with them as well. But always remember that you're the last in the credit queue, the creditors queue. The banks, and the banks are involved in this space at an arm's length, aren't they?
Yeah, exactly. Right. Understand
Mm.
you're the exit liquidity, right? That's you're how the
You're the
banks,
patsy.
yeah,
Yes.
right. You're how the banks get out of this. And look, let me give you, if you're watching this, let me give you another way to think about this stuff because it
Mm.
can help you. Ask a lot of questions and see if you get answers, right? So one of the things I do at Deep Knowledge Investing is I not only provide transparency to our subscribers into my personal portfolio. Like if you subscribe, you know what I own. I tell you, yeah, I own this much of this much of that. Um, and that's great. So you know, okay, I'm investing in the same way that Gary is. Great. We're invested in the same things. We'll make money or lose money together. There's at least integrity there. But the other thing I do is provide write-ups constantly explaining in detail why I own these positions. I update people on things. People send me questions. Our subscribers send me questions all the time. They have my personal email. They email me or put a comment on the blog, or there's, if you go to deepknowledgeinvesting.com, there's an Ask Gary tab. People click on that and ask me questions. And guess what? I give them answers to these things.
Mm.
Or
Mm.
sometimes people ask me really good questions. I'll turn it into a blog post and explain to people. So if somebody says, hey, you should invest in this, it's got a good return. Why? Why are you offering a higher return? Why is this a better return than other things I could be investing in? Right? Why are
Mm.
you offering that premium? Is it because you want to help me? See if you get good answers. And if you don't,
Mm-hmm.
run away. But if somebody says, hey, that's a good question, let's talk about it, and you get an answer but it's a higher return, right? Which is the finance version of ours go to 11 for the Spinal Tap fans in the crowd. Um, then that tells you something as well. Is the person who's selling this to you, the person who's selling it to you, do they understand it or not? Do they know their stuff or not? And I think you want to figure that out.
And I think it's also important just being able to have the language that you can ask the appropriate questions as well, and not to be afraid of asking those questions, and again, not to be bedazzled by these financial advisors. Just really think long and hard. And anyway, I think that's a great point to end. What do you think, Gary?
That sounds good. All right. So let's get ourselves wrapped up here. Phil, thank you so much
Okay.
for doing this. So good to
Oh, look,
have
thank you.
you.
Thank you for the opportunity, Gary. It's this undue respect I'm getting from fabulous financial people like yourself is fantastic, and I hope there hasn't been too much noise with my grandson running around in the background.
No,
Thank God
we're
for
big
noise
Otis
cancellation.
fans.
Yeah,
We're
that's
big
right.
fans of Otis, Phil's
The big
grandson
O,
at
the big O.
yeah, exactly. Right. We'll let you say that. Anyway, Phil, thank you so much for doing this. For people watching, please feel free to subscribe to Phil's channel, Stocks and Shares for Beginners. It's a terrific way to learn more about investing. Also want to credit DKI's interns, Cash and Crow, Samak Chain, and Gideon Rodham, who just do an enormous amount of work, even though they're back in school. And this was an extra long version of the 5 things. These guys just get a ton of research and work done, and the images, they're huge contributors. Rob Farian is not in the hosting chair this week at Flying V, our digital marketing partner, but he'll be back next week. For those of you who are Rob fans, always happy to have him around. And for those of you watching, we know your time is valuable. Thank you so much for spending it with us. If you want to give us a like and subscribe, we'd appreciate it. But hey, do what you want. We're not the boss of you. We'll see you next week.